Ratnesh Kumar, MD and CEO at Bob Capital Markets, is joining us right now on the show. Ratnesh, thanks very much for taking out the time. The mood of the market is optimistic, but obviously you are going to see near-term gyrations in terms of some amount of profit taking after that big bang move that we saw last week. But has the overall sentiment changed according to you? And is it is the time ripe to start making those big-ticket investments?
Certainly, the sentiment in the market has quite significantly changed after seeing very decisive actions from the government about a week back. So naturally, I think various steps were coming in earlier as well. But the move on tax, it has substantially changed the sentiment for sure, and that is reflected in the market. But naturally, the market will look to consolidate the gains as well as look at also the fundamental factors on the ground, because naturally the tax policy impact, some of that will be felt over the long term. So which is of course will be great if it can revive the investment sentiment or the capital investment downturn which is there, but the market will also focus on what comes ahead in terms of the earnings season and those kind of variables.
So do you think that while obviously this gives you that bit of additional cash on the balance sheet for most companies, profitability numbers will look good enough, but the growth that will spur the top line will still take some more time?
Yes. So first and foremost, I think there was a negative mood, within the market or in the corporate sector earlier. So it was important to sort of change the sentiment and change it in a decisive sort of way, which is what the government has done. I think now going forward, what it is that naturally some of these tax changes, they will have a more longer term impact in terms of derivative benefits, be it more cash on the balance sheet and what that makes companies do, etc. But change of sentiment itself is significant, and what we have to now watch for is how the months ahead, especially the festival season, if that brings demand back on the normal trajectory. All of that will be watched by the market as well.
Ratnesh, I want to go back to the comments that we just heard with regards to the meeting that most of these private lenders along with NBFCs had with the finance minister yesterday, and the positive takeaways from that push towards making sure that credit offtake happens in a meaningful way before festive season. And what's your take on this entire space?
So yes, I think all the steps which are being taken, I think it is definitely positive. The interaction with various stakeholders is also, it gives confidence to the market. So naturally, as we go into the festive season, firstly you will get data points from September from autos and other sectors. Those are not going to look good, but I think market will look beyond that and look forward to how it shapes up in October, how the rate cuts, how much impact they can have, and the additional liquidity which is being talked about, how that improves the financing environment in the festival season. And so yes, I think the decisive policy action what we've seen, what that has done is that it is enabling the market to look slightly ahead and not just look at what happened in September month, etc., which is a positive thing.
An interesting point to make, because we just did an auto dealer survey which looks at what dealers are talking about in terms of how the festive demand is going to be. And obviously last September, because of the base effect, you're not going to see a month-on-month expansion. It will still be a dip, but initial feelers are that it's going positive. The start of the season has not been bad. In light of that, autos, do you feel could see a change in overall sentiment in terms of the stocks at least?
So I think specifically in terms of auto stocks, I would think that it would still take a little while longer for for the business to come back to regular trajectory. So yes, if there is improvement as you suggest in the festival season, as dealers are saying, that will be an excellent thing. But there has been a sharp dip, and financing, especially what the NBFCs were doing in the auto space, that vacuum needs to be filled up. So I think it would be probably another 3-4 months at least before the business comes back on the normal trajectory, and I would still wait before trying to go bottom fishing in the auto space.
Right, Ratnesh, so how are you going about recommending making changes in portfolios, if at all? Where are the focus areas? What sectors are you focusing on? Where would you be buying? Where would you be looking to cut corners?
So at this point in time, I think overall market earnings growth has probably come down. The expectations have come down to 10-12%. So in that environment, I'm still, we are focused on looking at areas and sectors which are still growing. The business is steady and strong, and are somewhat less affected by the growth slowdown which has been seen in other sectors. So one of them will be gas utilities. It's a very stable business, and you have companies which are growing, be it in the gas distribution or in the LNG space. The other area is that while all the talk about credit growth, etc., continues, what is interesting is that overall housing loan growth is still quite decent, and that is being reflected in the fact that the home improvement companies, not the real estate space, which has its own issues in terms of offtake, but the home improvement companies, be it paints or ceramics, etc., they are still having a steady growth. So that would be another area. I think IT services would be another area where you are having a steady growth, and that has less of a linkage to the domestic growth variables. So those would be some of the sectors, and naturally banks. Banks are in a space where their business position within the financial sector has improved given the challenges being faced by NBFCs. So I think these are the 4 or 5 areas where I'm looking at either steady growth or something like a bank will lead the market and the economy out of the present slower growth phase. So those are the places to be in my view.
Right. So Ratnesh, would it be fair to assume that you would be focusing on banks which have a little more retail focus at this point in time, and that to frontline private sector banks?
Well, retail has been growing. Retail is steady, and so that continues as it is. But I think right now, even the corporate part of the business for the bank, the worst seems to be behind. In terms of NPA provisioning, etc. So I would not say that just to be focused on retail side of the business. Naturally, that is good, and there was positive view there that continues to remain good. But even the corporate banks, you will find that they will be able to do better than market average in terms of growth, etc. And the valuations are naturally quite low there, and that is where I think at this point in time one needs to be positive on both sides of the banking business.